Netflix just grew revenue 13.4%, ran a 33.4% operating margin, and bought back a record $4.7 billion of its own stock in a single quarter. The market's response? It sold the stock down 8% to a fresh 52-week low. This is the story of a beat that Wall Street hated, and what the sell-off says about what Netflix is actually worth. Start with the big picture. Revenue climbed from $33.7 billion in 2023 to $39 billion in 2024 to $45.2 billion last year. And for 2026, management just narrowed full-year guidance to between $51 and $51.4 billion. That is 13 to 14% growth, or roughly $6 billion of brand new revenue in a single year. And Netflix is getting more profitable as it grows. Operating margin has marched from 20.6% in 2023 to 26.7% to 29.5% last year, and guidance calls for 31.5% this year. That is 11 points of margin expansion in 3 years, which is why annual net income more than doubled over the same stretch, to $11 billion. Now, one thing you must know before reading any Netflix chart this year. In November 2025, Netflix completed a 10-for-1 stock split. Diluted shares went from about 435 million to about 4.3 billion. So this quarter's 80 cents of earnings per share is not a collapse from last year's $7 prints. On a split-adjusted basis, earnings per share actually rose about 11%, and net income grew almost 9%. Anyone showing you an earnings collapse is reading the split wrong. Here is the quarter Netflix actually reported. Revenue of $12.56 billion, up 13.4%. Operating income of $4.2 billion, a 33.4% margin, slightly ahead of the company's own forecast. Net income of $3.4 billion, and 80 cents of diluted earnings per share, a penny ahead of Wall Street's estimate. Every region grew revenue double digits. By almost any standard, that is a strong print. And yet, the stock fell almost 9% after hours, extended losses the next day, and touched $65.08, a fresh 52-week low. Friday's close of $68.95 leaves Netflix down about 25% this year, and roughly 46% over the past 12 months on more than 3 times normal trading volume. So why did the market sell a beat? 2 reasons. First, the guide. Netflix forecast third quarter revenue of $12.86 billion, shy of the roughly $13 billion Wall Street wanted, and that takes growth from 13.4% down to 11.7%. Second, disclosure. Starting in 2027, Netflix will publish its engagement report just once a year after already dropping quarterly subscriber counts. View hours grew only 2% in the first half. When a company dims the lights on a metric, investors assume the metric stopped flattering. Meanwhile, the cash story cuts both ways. Free cash flow fell to $1.5 billion this quarter, mostly on a one-time tax payment tied to the Warner Bros. Termination fee, and management held the full-year outlook at about $12.5 billion. Capital returns went vertical. Netflix repurchased a record $4.7 billion of stock in the quarter, nearly triple a year ago, and still has $27.1 billion of authorization remaining against a balance sheet holding $9.1 billion in cash. The bull case rides on what comes next. The advertising business is on track to roughly double to about $3 billion this year, with programmatic access expanding this summer. Live events are just 5% of content spend and 1% of viewing hours, yet 6 of the top 10 sign-up days in 5 years came from live. And the runway is bigger than you might think. Management says Netflix reaches under 45% of 800 million addressable households and captures just 7% of a $670 billion addressable revenue pool. So what is it worth? At $68.95, Netflix trades at about 21.7 times trailing earnings and under 20 times this year's consensus versus nearly 28 times forward earnings as recently as May. Our discounted cash flow scenarios, built off roughly $12.5 billion of free cash flow, land like this. A bear case worth about $41, a base case worth about $72, almost exactly today's price, and a bull case worth about $104, which happens to match the average analyst target. In plain terms, the market is paying for the base case and getting the bull case for free. These are implied values under stated assumptions, not price targets, and none of this is investment advice. The bottom line. Netflix won the streaming wars, and it is now priced like the war ended in a stalemate. Watch 4 things from here: whether fourth quarter revenue re-accelerates, whether the $3 billion ads target lands, the pace of those buybacks against a $27 billion authorization, and what the final semi-annual engagement report shows before the lights go annual. Show me stocks eventually show you something in one direction or the other. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai, link in the description.